Welcome to the Business Short Course Series presented by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. This course covers financial ratios and key performance indicators, also known as KPIs. Financial ratios are calculations derived from a company's financial statements, such as the balance sheet and income statement. These ratios are used by business owners, investors, lenders, and analysts to assess performance in areas such as profitability, liquidity, solvency, and efficiency, and to benchmark against competitors or industry standards. While there are many financial ratios, we will discuss only a few of these on the following slides. Let's start with balance sheet ratios. The current ratio, calculated as current assets divided by current liabilities, measures short-term liquidity or the ability to pay off short-term obligations. The quick ratio, which is cash plus accounts receivable divided by current liabilities, is a stricter test of liquidity as it excludes inventory from assets. Next, we have profitability ratios. The gross profit margin, calculated as gross margin divided by revenue, indicates how efficiently a company produces and sells its goods. Return on assets, which is net profit divided by total assets, measures how effectively assets are used to generate profits. The profit margin, calculated as net profit divided by revenue, shows the percentage of revenue that becomes net income. Lastly, return on equity, which is net profit divided by owner's equity, assesses how efficiently equity is being used to generate profit. Other important ratios and metrics include the debt-to-equity ratio, which is total liabilities divided by owner's equity and evaluates financial leverage and risk level. Inventory turnover, calculated as revenue divided by inventory, measures how efficiently inventory is managed and sold. EBITDA, or earnings before interest, taxes, and depreciation and amortization, indicates operational profitability by excluding non-operating expenses. What are key performance indicators? Key performance indicators, or KPIs, are measurable values that demonstrate how effectively a company is achieving key business objectives. They provide insights into performance, guide strategic decisions, and track progress towards goals. KPIs can be categorized into different types. Financial KPIs, which measure things such as revenue growth, profit margins, and return on investment. Operational KPIs, which measure business objectives like process efficiency, cycle time, and productivity rates. Customer KPIs, which measure things like customer satisfaction, retention rates, and net promoter score. And employee KPIs, which track things such as employee engagement, turnover rates, and training effectiveness. KPIs are crucial for performance measurement, strategic alignment, decision-making, and accountability. They help assess the efficiency and effectiveness of operations, ensure activities are aligned with business objectives, facilitate informed decisions based on data, and set clear expectations while tracking outcomes. To develop effective KPIs, align them with your strategic goals and make them SMART: specific, measurable, achievable, relevant, and time-bound. This ensures that KPIs are clear, quantifiable, realistic, pertinent to the business context, and have a defined time frame for achievement. Common pitfalls in KPI development include choosing too many KPIs, selecting KPIs that are not aligned with objectives, and failing to update or review KPIs regularly. Best practices include involving stakeholders in KPI development, using data visualization tools for clarity, communicating KPIs and progress transparently across the organization, focusing on a few critical KPIs to avoid overload, and continuously assessing and adjusting KPIs as needed. Let's look at an example of how to implement KPIs. In this scenario, a retail company aims to improve customer satisfaction. Selected KPIs include a customer satisfaction score of 95%, decreasing average response time to customer inquiries, and increasing the repeat purchase rate from 5 to 7% of customers. The outcome of tracking and improving these KPIs should be improved customer loyalty and increased sales. Let's test your knowledge with a pop quiz. What does M stand for in SMART? Is it A, maximum, B, momentum, C, moderate, or D, measurable? What's the most important KPI? Is it A, financial, B, operational, C, customer, D, employee, or E, all of the above? What ratio measures if an asset is generating profits? Is it A, the quick ratio, B, the profit margin, C, return on assets, or D, none of the above? If you need extra time to determine each answer, feel free to pause the video now. We'll show the answers in just a few seconds. Here are the answers to the pop quiz. The M in SMART stands for measurable. The second question is sort of a trick. All these KPI categories deserve company focus, and the most important KPI can vary depending on the business context. For the last question, the ratio that measures if an asset is generating profits is return on assets. Thank you for listening to this presentation brought to you by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. We're here to help you make informed and confident decisions for your business.